Okay, so I'm going through one question. These questions will show us how to make journal entries on the issuance of common shares and also in a situation where companies will repurchase their common shares back. So this is a question. On June 8th, this company was incorporated and issued 24,600 common shares for $246,000. On August 19, an additional 6,150 shares were issued for 73,800. On November 2nd, the company paid $23,616 to repurchase 2460 common shares. So this is the repurchase. So the company will buy back these shares. And on December 7th, the company paid $42,640 to repurchase 3280 common shares. So I have two questions here. The first question is asking, calculate the average cost of the common shares on the 4 dates in the question. The second is to prepare journal entries to record the transactions on the 4 dates. Okay, so let's take a look at so let's take a look at the first question. On June 8th, Crane Ltd was incorporated and issued 24,600 common shares for $246,000. So the cost would be the total money you spend divided by the number of shares you required. So this actually is pretty even numbers. So you get $10 per share. Okay. On August 19th, an additional 6,150 shares were issued for 73,800. So if you want to know the average cost outstanding for the outstanding shares, so you just have to calculate after this second issuance, what is the total money you have spent. So the total cost is the first issuance, 246,000, plus the second issuance, 73,800, divided by what's the total number of shares after the two issuance, right? So I have 24,600 plus 6,150. So when I do this division, I calculate it. So it turned out that the average cost is $10.40. On November 2nd, the company, this time, they pay money to buy shares, okay? So this is the reverse process of the first two transactions. The first two transactions is that they give out shares in exchange for the investor's cash. So they receive cash, they give out shares. But when they repurchase, that means they buy these shares back. So they give the cash to the investors, so they get all these shares back. Okay, so that's what we mean here. So when you think about the shares, when you do not buy new shares, basically there's no new purchase, so the average cost stays the same. Well, you may ask, the number of the shares is reduced, right? Well, when we have this number of shares reduction, the cost will be reduced accordingly, okay? So you use the average cost of $10.40, right, to redeem the cost of the number of shares you redeemed, okay? So on December 7th, it paid this amount of money to repurchase this number of shares. Again, they were not issuing new shares. They are not purchasing, there's no investor purchase. Okay, so the average cost will stay the same. So $10.40. Okay, now let's take a look at the journal entry. So on the first two dates, this is quite straightforward. When you issue common shares, and then you raise money, right? So basically, your cash balance will increase. You receive the cash from the investors, so you debit the cash, okay? At the same time, the equity increased, right? Because the number of the common shares is increasing, right? You are issuing more common shares, so the equity increased. So equity has a normal credit balance. So in order to increase the equity's balance, you need a credit equity, right? So the journal entry is the same. You debit cash, you credit the common shares when you are issuing the common shares. So I think the first two journal entries is quite straightforward. Students might find challenging for the last two journal entries, which I'm going to spend some time to explain. So on November 2nd, okay, we know that they paid $23,616. Okay, so now should be the easy part, right? The company paid the cash, so the cash balance decreased. So you have to credit the cash, right? You credit the cash for $23,616. And then you are buying the common shares back, your common shares will be reduced. So you debit common shares. The question is, how much do you debit? Well, we know that the purchase back 2,460 common shares, and we know the average cost is $10.40, right? So then I use this multiplication, the number of common shares bought back times the average cost. So I immediately before the repurchase, right? So $10.40. So I know that the cost reduction on the common shares is 25,584. So now we notice that, see, the debit is not equal to credit. So when I'm comparing to make this journal transactions balanced, I will need additional credit, okay? So then this difference is due to the share price changes, right? So it costs you $10.40 to buy, right? To issue. So the investors paid $10.40 to buy these shares from the company. But the company on November 2nd, they were able to bought back these shares at a cheaper price, right? So the company is gaining some money, okay? So in that case, we will credit contributed surplus. This account, contributed surplus, is an equity account. This account will capture the balance due to the issuance and purchase buyback common shares, and because the issuance price and the buyback price, they are not exactly the same. There's a price fluctuation in the market, so you may contribute to this contributed surplus. In our example, this is a good scenario. The buying back price is lower than issuing price. So the company is actually benefiting from that, right? So when you credit contributed surplus, right? This is equity account, the balance increased, right? Equity balance increased. That's the good news. Now, December 7th, right? They paid $42,640. Again, if you don't know anything else, you need to know that this transaction will decrease my cash balance by $42,640. Therefore, I need to credit the cash for that amount. So now let's calculate the common shares cost, right? Well, repurchasing back 3,280 common shares. And we know the cost of each share is $10.40. So we are saying, guess what? The cost balance of the common shares, it decreased by this amount. Okay, therefore you have to debit common shares. So now I'm comparing 34,112 and 42,640. I realize that I need additional debit. Okay, so where this debit is coming from? Well, first, we know that on December 2nd, we already have some contributed surplus, right? So we already have some contributed surplus here, 1968, right? So now in this scenario, December 17th, probably the stock price is going up. It costs the company more money to buy it back, right? So the company will first use contributed surplus. Now you can debit, and for the entire amount, 1968. So when I add 34,112 plus 1968, so I have $36,080. So the total debit is still less than the total credit, 42,640,000. So therefore, I need additional debit. Okay. So when I need additional debit, think about from equity, right? What else from equity? The only thing left is return earnings, right? Because it won't come from anywhere else, right? If you think about the equity account, this is where the last account you can resort to, right? So that's the difference, 65.60, right? So how did I calculate 65.60? This is the amount will keep the total debit and the total credit equal, okay? So I hope this makes sense. Have a nice day.